How cash value life insurance is taxed, the core mechanics. Here's the plain English foundation. Your policy has a few numbers that matter for taxes: your basis, your cash value, your surrender value, and any loans. Basis is the total of premiums you've paid, adjusted for things like dividends you took in cash or reductions from certain withdrawals. Cash value is what's accumulated inside the policy. Surrender value is the cash value minus any surrender charges. Loans are money you've borrowed from the policy, usually secured by the cash value. The thing most people miss is how gains are taxed. Gains are simply what you get out minus your basis. When those gains are recognized, they're taxed as ordinary income, not capital gains. That's why the tax hit can feel so big. There's no lower capital gains rate on these policy gains when you surrender or trigger a taxable event. Now, before we continue, you need to understand the difference between non-MEC and MEC. A non-MEC is a policy that wasn't overfunded according to IRS rules. With a non-MEC, the tax rule is FIFO, first in, first out. That means withdrawals come out of basis first. So if your basis is $80,000, and your cash value is $110,000, the first $80,000 you withdraw is generally tax-free. Only amounts beyond basis are taxable. This next part separates beginners from pros. MEC status flips the order. A MEC, modified endowment contract, happens when a policy is funded too aggressively. With a MEC, it's LIFO, last in, first out. That means gains come out first. So withdrawals from a MEC are taxable up to the gain. And if you're under 59 and a half, there's typically a 10% penalty on top. Many seniors are over 59 and a half, so the penalty may not apply, but the ordinary income tax still does. If you remember nothing else, remember that MEC status changes the withdrawal order and can cause surprise taxes. Let me show you exactly how loans fit. Loans are generally tax-free while the policy stays in force because you're borrowing against the cash value, not withdrawing it. The reason this works is the loan is an income. It's debt secured by the policy. But here's where most people mess up. If the policy lapses or is surrendered with a loan outstanding, the IRS treats the loan balance as if you got that money out. That can create taxable income up to the gain in the policy, what many advisors call the lapse with loan tax bomb. You didn't get a check at lapse, but you can still owe taxes as if you did. Dividends create confusion too. On participating whole life, dividends are generally treated as a return of premium until you've recovered your basis. After that, dividends are taxable. If you use dividends to buy paid-up additions, you're increasing basis differently than if you take dividends in cash. The insurer's statements should show how dividends were used and how your basis was adjusted. Actually, let me back up and clarify basis tracking. Your insurer should keep a record of total premiums paid, dividends taken in cash, withdrawals, and loans. But records get lost, policies get moved, and demutualization events, when a mutual insurer converted to a stock company and gave policyholders stock or cash, can affect basis. If you received stock in a demutualization, there can be basis allocation questions between the policy and the stock. Get the original demutualization letter and any tax documents to correctly adjust basis. This is why pulling a complete policy history matters before you touch anything. Now, once you nail the mechanics, everything else clicks. For non-MEC policies, a common strategy is withdraw to basis first, no tax, then use loans for additional access. But even with loans, you've got to manage interest and avoid letting the policy run on fumes. Rising loan balances, lower credited interest, or increasing costs of insurance can push a policy toward lapse. And that's exactly when the tax bomb can go off. Cost of insurance and policy charges matter, especially with universal life and variable universal life. If charges rise with age and credited interest lags, cash value can erode. That can force you to add premiums or reduce the death benefit to keep the policy in force. An in-force illustration from the insurer shows you how the policy behaves under different assumptions. Loan rates, crediting, rates, market performance for variable policies, and ongoing costs. Use that to stress test sustainability so you don't stumble into a taxable lapse. One more nuance: surrender charges. If you surrender during a surrender period, the payout may be reduced by those charges. For tax purposes, your taxable gain is typically based on what you receive plus any outstanding loan minus your basis. The surrender charge lowers what you receive, but doesn't usually reduce your gain dollar for dollar like basis does. That's why surrendering at the wrong time can feel like a double whammy: less cash to you and ordinary income on the gain. The quick win today: confirm whether your policy is a MEC, verify your current basis from the insurer, and request an in-force illustration with and without loans. With those 3 data points, you'll see your exposure and avoid triggering accidental taxes. The tax bomb triggers seniors Mississippi. Now, here's where most people mess up: the lapse with loan surprise. You borrow over the years, the loan grows, interest accrues, and the cash value struggles to keep up. Then a premium gets missed or charges spike, and the policy lapses. The IRS treats the outstanding loan like you took a withdrawal the day the policy died. If there's gain, cash value plus the loan minus your basis, that amount is ordinary income. You don't get a check, but you can still get a 1099 and owe tax. That's the tax bomb, avoidable with a few proactive safeguards. Seniors often trigger this while simplifying. They surrender a policy to tidy up accounts or free up cash, but they don't confirm basis, MEC status, or loan balances first. If the policy is non-MEC, withdrawals up to basis could have been tax-free, but a full surrender recognizes the gain all at once. And if there's a loan, surrender accelerates the recognition too. The result is a big spike in income in 1 year, which can also push up Medicare IRMAA 2 years later. The fix is simple: map your basis and loan first, then decide how to access value. Reduced, paid up, and partial withdrawals can be smart, but here's the catch: crossing your basis turns on taxation immediately. People assume partial equals small tax. Not necessarily. On a non-MEC, you're fine until you pass basis. On a MEC, even a tiny withdrawal can be fully taxable up to the gain. The trick is to confirm your remaining basis before you take a dime, then structure withdrawals to stop right before basis is exhausted, and use loans after that if keeping the policy. Missed premiums within 60 days cause another silent trigger. Many universal life contracts have grace periods. If you miss a notice or two, the policy can enter a short window where it'll lapse unless you pay a specific amount by a deadline. Life gets busy, mail gets buried, the date passes, and the policy lapses. With a loan outstanding, that lapse becomes a taxable event. Set auto pay, email alerts, and calendar reminders. Ask the insurer to send lapse warnings by multiple channels. Don't rely on a single envelope in the mailbox. Demutualization adds to confusion. If your mutual insurer converted to a stock company and you received stock or cash, basis calculations get tricky. Some folks overstate taxable gain because they don't adjust basis for dividends treated as return of premium or for demutualization allocations. If you received shares, the stock basis is usually separate from the policy basis. Mixing them can distort your numbers. The move here is to retrieve the demutualization letter and any 1099s, then have your CPA confirm the correct basis adjustments. Let me give you a quick micro story. A client in her late 70s had a universal life policy with a modest loan, about $24,000. She paid premiums for decades, basis roughly $95,000, cash value around $120,000. She missed 2 notices during a hospital stay. The policy lapsed. The insurer issued a 1099 for the gain tied to the outstanding loan and remaining value. Her taxable income jumped right on top of Social Security and IRA withdrawals, which not only created a tax bill but pushed her into a higher IRMAA bracket 2 years later. The difference maker? She didn't have alerts or a standing instruction to cover shortfalls. We appealed the timing on IRMAA using the life-changing event rules the next year, but the tax year was already locked. If she'd had a small emergency premium paid or reduced face amount earlier, the lapse wouldn't have happened. Another trap is relying on illustrations from years ago. Interest crediting falls, cost of insurance rises with age, and variable subaccounts can dip. What looked fine 5 years back may be on the edge today. If you've been taking loans, compounding loan interest can accelerate the slide. The practical move is an annual in-force illustration with a worst reasonable scenario: lower crediting, higher loan rate, current charges. If the projection shows a lapse in the next 3 to 5 years, act now. Pay interest, reduce face, switch to reduced paid up, or consider a 1035. Also, beware beneficiary changes and ownership shifts done casually. A transfer for value can turn death proceeds taxable to the transferee unless an exception applies. While that's a death claim issue, it intersects with surrender planning. If you're thinking about selling the policy or transferring it to a new owner before a life settlement review, get advice first so you don't accidentally taint the income tax-free nature of the death benefit. Finally, timing matters for year-end moves. If you're going to surrender, a December surrender can bunch income and trigger IRMAA later. Sometimes waiting until January is smarter after modeling with your CPA. Or better yet, defer with a 1035 if it aligns with your goals. The practical takeaway: don't take actions that force all the gain into 1 year without running the numbers. Policy types and what changes tax treatment. Before we run numbers, you need to know how different policies behave because the tax rules meet the product design in messy ways. Think of it as the same tax code, but different engines under the hood. Whole life first. Cash value grows at a declared dividend scale on top of guaranteed interest. It's boring in a good way. Steady, less volatile. Dividends are generally a return of premium until basis is recovered, then taxable. Many whole life owners use dividends to buy paid-up additions, which increases both cash value and basis in a predictable path. The risk here is usually not market swings. It's rising policy loan interest versus credited rates. If loan rates outpace what the policy credits for too long, loans can snowball toward lapse. For taxes, the big trigger is still lapse with a loan or crossing basis with withdrawals. Now, universal life. UL credits interest at a rate the insurer declares, and costs of insurance ramp with age. If credited rates drop or costs rise, your cash value can erode faster than you expect. Indexed UL credits based on an index formula with caps and participation rates. Variable UL invests in market subaccounts, so it can swing up or down. The tax rules, FIFO for non-MEC, LIFO for MEC, still apply, but UL's flexibility creates more ways to accidentally lapse, missed premiums, underfunding, loans growing while crediting lags. That's why in-force illustrations matter more here. The same tax bomb exists, but the fuse is shorter in down markets or low crediting periods. Variable UL adds market risk. Gains and losses flow with the subaccounts. If markets fall, cash value can drop while monthly costs keep coming out. That increases lapse risk and shortens the runway if you're carrying loans. Tax-wise, gains are recognized when you surrender or lapse. There's no capital gains rate on those policy gains. They're ordinary income. However, within VUL subaccounts, you're not taxed annually like a brokerage account. Tax is deferred until a taxable event at the policy level. That's a benefit, but it can hide risk until the day you act. Let's talk MEC status because it overrules withdrawal order. Funding too fast. Exceeding the 7-pay limits turns a policy into a modified endowment contract. MEC status sticks. You can't un-MEC a policy by waiting. With a MEC, withdrawals and loans are taxed LIFO up to gain, and pre-5/9 1/2 distributions carry a 10% penalty like an annuity. Most seniors are past that age, but the LIFO taxation still bites. Loans on a MEC don't save you from current taxation. They're treated like withdrawals. For many, that alone changes the access plan. Either avoid distributions altogether, do a 1035 exchange to a more suitable contract, or coordinate withdrawals with medical deductions to offset income. A quick word on Section 7702 and corridor rules. These define how policies qualify as life insurance for tax purposes and set funding limits and death benefit corridors. Recent updates beginning in 2021 changed interest rate assumptions used in testing, which impacts how much premium can go in before MECing and how cash value is designed. The practical takeaway: newer policies can be structured with more flexible funding without tripping MEC as easily, but you still need confirmation of status from the insurer before touching cash. Riders change access and sometimes taxation. Long-term care and chronic illness riders can allow tax-advantaged accelerations of the death benefit if you meet the rider's criteria. Those accelerations are different from loans or withdrawals. They're generally designed to be income tax-free up to limits when qualified. Return of premium riders or overloan protection riders can help manage lapse risk late in life, but they come with rules and potential charges. The thing most people miss is rider triggers aren't automatic. You often need physician certification or to satisfy ADL limitations, and benefit caps apply. Illustration versus reality is where plans fail. UL and IUL illustrations assume crediting rates and loan arbitrage that may not materialize. VUL assumes investment returns that can go sideways. Whole life assumes a dividend scale that can change. The reason this matters for taxes is simple. If reality underperforms, loans or withdrawals that looked safe can push the policy toward lapse, turning a tax-deferred asset into immediate ordinary income. Annual checkups let you adjust before the tax bill appears. So here's the shortcut nobody teaches. Match the policy type to your access method. Whole life, favor withdraw to basis and conservative loans. Consider reduced, paid up to cut costs. UL/IUL, monitor crediting and costs closely. Reduce face to stabilize, keep loan to value modest. VUL, treat loans with extra caution. De-risk subaccounts if you'll borrow. MEC, lean toward 1035 exchanges or plan distributions with deductions. Once you align the engine with the road you're driving, your tax risk drops fast. Quick math. Estimate your tax hit before you touch the policy. Let's run the numbers so you can see the size of the tax before you make a move. Grab 4 figures. Total premiums paid to date, that's your basis. Current cash value, any surrender charge today, and your outstanding loan balance including accrued interest.